China may need to do more to support its economy after data showed its post-health crisis recovery was patchy. Figures out Friday showed the country's struggling property sector worsened again in November. The dual problems of negative homebuyer sentiment and debt-hit developers drove down sales and investment. China has struggled with factors including a distressed housing market, local government debt, and weaker global demand. And while the Asian giant did grow faster than expected in the third quarter, home demand is still weak. A range of policy support measures has improved things only modestly, raising pressure for more stimulus. Analysts warn different parts of the economy are running at different speeds. Friday's data showed China's new home prices fell for the fifth straight month in November. Property investment was down close to a tenth on the year between January and November. Industrial output did grow 6.6% last month year on year though, much faster than in October and ahead of expectations. But analysts struck a cautious note on the improving output data. They warned factory gate deflation deepened last month and that a full-blown economic recovery was some way off. The inconsistent recovery has pushed analysts to warn China may fall into Japanese-style stagnation later this decade without more support measures. This week, top leaders said they would step up policy adjustments to support economic recovery in 2024 with a focus on boosting domestic demand. Sources further told Reuters that Chinese leaders agreed this week to run a budget deficit of 3% of gross domestic product next year, and other fiscal support may be covered by off-budget debt. The deficit figure is lower than this year's revised 3.8% target and suggests Beijing wants to maintain fiscal discipline. But the option to issue off-budget sovereign debt gives it flexibility to step up stimulus to maintain stable economic growth.